so you've heard the term DSCR, but what does it really mean and how does it work? A DSCR loan is for investment properties only. You cannot live there. You cannot have a family member live there. You can't move in there after you purchase the property. That's really, really important. But aside from that, it stands for debt service coverage ratio. And we don't care about any of your other income. We don't care about your car loan. We don't care about any of your other home loans. We don't care about your credit card debt. We don't care about your job. We don't care about how much income you're showing on your tax return. We don't care about any of it. The only thing we care about is how much money you're renting the property for. And this can be used for both long-term rentals and short-term rentals. So let me explain to you high level how this works. So let's go ahead and share my screen right now. And what you're going to see is an example that says, all right, if you are buying a $500,000 home with 20% down, your down payment's $100,000, your loan amount is $400,000. At an 8% interest rate on a 30-year fixed rate loan, your principal and interest payment is $2,935. We're looking at property taxes of about $520 a month, and we're looking at insurance of about $100 a month. That adds up to $3,560 a month for your house payment. Now, for what we're doing is we're simply dividing the rental income divided by the mortgage payment. So as long as the rental income is bigger than the mortgage payment, then we're super happy. And if it's a lot bigger, we're super, super happy. So if it's 1.25% or 1.25 times, which is 125%. So you take the rental income compared to the mortgage payment. And in this case, if it's higher than $4,450, you are top tier. You're going to get the best interest rates and terms because it means your rent is more than 125% of the mortgage payment. But in this case, as long as the rent is $3,560 a month, you're good because that's 100%. And you say, yeah, but John, this property's not renting for that much. I guess I'm out of luck. That's not true. As long as you have at least 75% coverage, 75% of the rental income the rental income is covering 75% of the mortgage payment, I can usually still qualify you. This really comes into play when people are pulling cash out on a property or buying a property that has low rents right now, that they can raise the rents later. Which brings up my next point, which is I want to show you how we calculate the rental income. So it depends, first of all, if it's a purchase or a refinance. And it depends on whether it is long-term rental or short-term rental. So if you follow along with me here, I'm showing you the guidelines. If it's a purchase transaction, we simply use the rents that are on the appraiser's form. This is the Fannie Mae form 1007 or 1025. That's the appraiser saying, hey, I've looked at other houses in the neighborhood, how much they're renting for, and this is the average that I think this property would rent for. We simply use that number. Now, if the property is currently tenant occupied, then we have to compare that to what the current tenant is paying. Why? Well, because if there's somebody currently living there, we're worried that if they're going to keep living there, that's your real rent. And so if we look at that, if we're using the lower of the two, no big deal. So the appraiser says, hey, this can rent for $4,000, but currently it's renting for $3,000. As long as we're okay with the $3,000, we're perfectly fine. If you want to use the higher of the actual lease, so in that case, the appraiser says, hey, this thing rents for around $3,000 a month. And you're like, no, really? I have a tenant in there. They're paying $4,000 a month. Then I can use the higher number as long as it's within 120%. So in other words, look, the appraiser says this thing can rent for $3,000 a month. Well, 120% of that is $3,600. So that's the highest that we're going to round up from the lower of either number, whether it's the rent that is lower or the lease amount that's lower. We're only going to round up by 20% to get closer to the other one. We won't exceed what the higher number is. So if the appraiser says it rents for $3,000 and you have a lease agreement and 2 months of receipts showing that you've been collecting $3,300, well, then we can use the $3,300. Because that's less than 120% bump. I'm here to help go through the numbers. I want to explain it all to you, but it's case by case as far as understanding it in detail. If you want to use the higher amount that is on the appraiser's opinion, we can only go up to 120% of what the appraiser said. So if the appraiser says $3,000, but the current rents are $3,000, and you're like, no, those are below market rent. I can really rent this thing out for $4,000. I'm not going to allow you to use $4,000. Again, I think I'm saying this backwards. Let me say it again. If the current rent is $3,000, and you're like, hey, I'm going to move them out, and I'm going to be rent it for $4,000, and the appraiser agrees it can rent for $4,000. Cool. I'm okay with that, but I can only use up to 20% higher than what the current rent is. There's some tethers. There's a cap to how much higher we can go. But hopefully that helps explain that piece of it. If it's vacant or unleased, then we're okay with it. If it's subject to rent control, then we have to use the current contractual amount. We can't bump it up by that 20%. On a refinance, then we need to see both again. We've got to see the appraiser's opinion, and we need to see the copy of the lease agreement with 2 months of proof if it is month to month. And bottom line is we're going to use the same concept. We're going to take the lower of the two, or we're going to round up by up to 120%. The last thing I want to cover is what if it's a short-term rental. So this is super cool. We can do DSCR loans, even if it's a VRBO, an Airbnb, etc. But on short-term rentals, we throw away 20% of the gross rents. So depending upon the circumstances, essentially, I'm gonna simplify this. I'll make it smaller. You can still see it, but I'm going to oversimplify this. You can take a screenshot of it if you wanted to. But here's the deal with short-term rentals. If it is currently a short-term rental, we're going to use that dollar amount. If it is not currently a short-term rental, we're going to get a projection. We're going to either have the appraiser tell us. We're going to use third-party documentation. There's websites like AirDNA that we can look and see what properties in that area rent for as short-term rentals. We're going to look at the actual vacancy rate, like if depending upon the vacancy rate and how popular that property is going to matter to us. And it's all going to be an underwriter discretion decision. There are some short-term rentals that we're not going to do because there's just so high of a vacancy rate. There's others that we will because, hey, it's seasonal and it's super busy during the season, and then it's not very busy during the off season. But we're always going to use a 1-year average. We're never going to take 1 month or 2 months because there are seasonal adjustments. So we're going to look back a year when it comes to either a property that you are refinancing that is currently a short-term rental. We're going to ask for your statements from Airbnb, VRBO, etc., to add up what your rents were. We throw away 20% of those rents, and the remaining amount that is left over is what we use to calculate your debt service coverage ratio to determine how big of a loan amount you can do. Hope that makes sense, guys. I really appreciate you listening. I am absolutely interviewing to be your lender. So please go to my website, canilandlord.com. I've got a lot of good blog posts there, some tools there. You can click on request a consultation and have a conversation with me. I am looking forward to helping you grow your real estate portfolio. So yes, you can landlord, and I'm going to help you get there. So if you're looking to buy your first one or your 10th one, growing your portfolio to whatever size fits your dream is what my goal is, and I want to help you make that happen. Thanks for joining me, and hope you have a wonderful day. Bye-bye.